welcome back to Never Change. Here I intend to go through my analysis of Ericsson. So what is Ericsson? Ericsson is a Swedish multinational network and telecommunications company. The company offers services, software and infrastructure in information and communication technology for telecommunication operators, traditional telecommunications and internet protocol equipment. Mobile and fixed broadband, operators and business support services, cable television, yada yada yada. Founded in 1867, headquartered in Stockholm, Sweden, have approximately 100,000 employees and an annual revenue of around $27 billion a year. And the CEO, I won't pronounce this right, is Björn Ekholm, I believe, since 2017. They have a lot of competition in the area that they're in at the moment because they're trying to make a headway into and foothold into the 5G space. So they'll have competition from Samsung, Qualcomm, Nokia, and also Chinese companies of ZTE and Huawei. So not so much the Chinese competitors if you're looking at Western markets, because of a couple of governments have banned the use of Chinese technology on their networks. So let's start the analysis. So Ericsson's credit rating is not great. I believe this is because they had a huge write-off in 2017, which they have pretty much recovered from, but the credit rating is still showing that they are just above speculative, risky. Common size analysis. So this is why I like this stock. So for me, everything is trending in the right direction. Just to clarify as well. So the figures here are in Swedish kron, not US dollars. So if you wanted to convert this to US dollars, just divide it by around 10. So revenue trending in the right direction. Increasing year on year. Cost of goods and services are decreasing, so they're becoming more efficient. So even as the revenue grows, they're becoming more efficient with how they deliver their goods and services. Gross profit is also trending up and increasing in value. The thing I like about this is it's actually increasing in the percentage of revenue as well, so very good indicator. The operating expenses are trending down, so even though their revenue is going up, the gross profit is going up, they're doing it with less. I like that they're heavily investing in research and development, so that currently stands at about 17% of their revenue. So the operating expenses, you can see that they had a horrendous year in 2017, but they've pretty much recovered from it now. And you can also see that reflected in pre-tax income and net income. So earnings consensus, they've met or beat every one of the 2020 consensus targets for EPS. That's really good considering what happened in 2020. And also the financials also look great. The shows that negative earnings in 2017, now positive. So Moat Analysis, so this was slightly difficult to do for EPS because they had a negative EPS in 2017. So I've done it for last year versus this year, which it shows 180% increase. We're looking for about 10%, so that's good. Operating cash flow per share increased by 31% on average over 4 years, revenue 4%, but book value per share is decreased by 4% on average over the last 4 years. Return on equity, return on invested capital. So the return on equity stands at 20%, so looking for 10%, so that's a really good indicator. And return on invested capital stands at 16%, so we're looking for 10%, so excellent. So that with the cash invested, they're investing it well. The debt to earnings ratio is 1.27 years, so again, all good indicators there, nothing to worry about. Margin of safety, so based on the current parameters, based on the last 12 months, so earnings per share is $0.59. Earnings growth rate, probably a bit optimistic here, but 19%. Future PE multiplier 15.83 based on analyst consensus, and looking for a minimum acceptable return of 10%. So with a 25% margin of safety, that would give a price of $15.38 based on a current valuation of $20.51, and on a 50% margin of safety would be $10.25. And so at the time of this filming, it's currently trading just under $14 a share, I believe. So it sits at around the 30% margin of safety mark, so indicating pretty good buy at the moment. So let's see how the foundations are. 8-pillar analysis. So it passed 6 of the 8 pillars based on a share price of $13.61, market cap of $44.96 billion. PE ratio sits at 15.83, looking for less than 20, so all good there. Profit margin slightly under the 10% that we're looking for, currently standing at 7.52%. So that's better than some of the competition, because Nokia's minus 11%, but not as good as, say, Qualcomm, who's currently sitting at 20%. Revenue growth, there is, not great. Profit growth, yes, massively, but they're coming out of a very bad situation, so it would be quite a large number. They are increasing their shares. Current assets greater than liabilities, it is, but liabilities sit at 68% of their assets. Free cash flow is growing and at a considerable rate, plus 40% on last year. So based on the current share price at $13.61, the price to free cash ratio is 19.05, which is at the high end of the scale that we're looking for. So if we go through again with a 50% margin of safety, which is $10.25, so outstanding shares 3.3 billion would give a market cap of $33.1 billion. Free cash flow of $2.3 billion would give a price to cash flow ratio of 14. So if this stock was trading at $10.25 a share, it's a steal. So let's cover, so what's the pros regarding continued growth. They do have a global footprint. They are in the 5G space, which is really taking off at the moment. They offer new services, infrastructure, software, etc. They already have 83 live 5G networks in 41 different countries. They're investing massively in 5G, and R&D accounts for 26% of their workforce currently. And just to put it in perspective, by 2035, 5G will be worth approximately $31 trillion. But then, and they are also trying to diversify. They're investing in AI. So limiting factors, there's a lot of competition in the 5G space at the moment. And if this company wants to continue to grow, it's going to have to diversify. It can't just rely on 5G for future growth. And also to put its competition in a bit of perspective, so 5G patents, top companies that have declared them. Huawei sits on top with 6,372, then Qualcomm, then Samsung, then Nokia, then LG, then ZTE, and then you've got Ericsson. So it would be worth comparing Ericsson to Qualcomm to see what would be the better investment. So in conclusion, the credit rating is not great. The common analysis looks fantastic. It shows that they have had a really bad 2017, but they seem to be roaring out of it. The Moat analysis looks good, nothing to worry about. The return on equity, return on invested capital also look great. There's no worries in regards to them servicing their long-term debt. 8-pillar analysis could have been better, but you could probably let them off a little bit based on the hardship that they have had in 2017. So Ericsson has good good growth potential for going forward. The risks are manageable, I believe. I do believe at the moment they are undervalued. I would value them at around $20 a share, and currently at the time of filming this, they're trading at $13.61 a share. So a good price using a 25% margin of safety would be anywhere between $15 to $20. So what do you think? Yeah, have I missed something? Are you also quite bullish on Ericsson? Please leave a comment, let me know. And yeah, see you again. Thank you.